Hey everybody,
train.
welcome to the YourOrlando.com Orlando Real Estate Report for the month of October 2014. Have another interesting month in real estate with some new developments on the sold side of the market. And so today we have with us Alex Arribas, listing manager
Nope.
extraordinaire. We've got Brendan Rendo.
Morning, everyone.
And we have a new addition to the team, uh, Lionel Ramirez. So Lionel, can you turn the camera towards Lionel?
I think he stepped out for just a moment. Be right
Oh,
back.
okay,
I'll
my
make
bad.
sure he says hi.
Okay, gotcha. All right, well, with that, we're just going to go ahead and jump right into the slides. And this is always an adventure, so let's see if we can do this screen share without blowing this thing up. So here we go. Okay, can you guys see the screen okay, the slides?
No,
Not yet.
Okay, how about now? Still nothing?
Not
no.
yet. He's just
No.
joined in though.
Okay, how about now?
Not yet. There it
Yeah,
is. It's
Okay.
there it goes.
there we
You got
go.
it.
Okay, so we've
Yeah.
got the slides now, right?
Yep.
Okay, great. Okay, looking at the inventory for the past 24 months, um, going back to March 2013, you see we had 7928 listings there, and it's gone up considerably. And now in September, we're at 14,068 listings. So that's quite an increase. And so the next slide I want to look at is just the inventory in a different format. And here you can kind of see over the past 3 years what you have. And specifically, we're looking at the month of September, which we just closed out. And so I forgot to put my numbers there. Uh, who's typing? We got some background noise there. I'm not sure if if you guys can hold up on that for just a minute. Okay. Next thing I want to talk about is median home price. Okay, median home price. We in September for the past 3 years, we started out in 2012 at 123,744, and then last year we were at 155, and now this year we're at 166,000. Okay, and moving forward, next slide I want to look at. This is pending home sales, and here's something that I'm concerned about. This in addition with the inventory going up, and I guess a big part of it is it looks like fewer people are submitting contracts, as you can see right here. We just have fewer homes that are going under contract. So that that's something that we want to keep an eye on because the inventory is going to build. The number of homes going under contract is fewer now, and that could have an impact on prices. And if you go back, here we're actually looking at prices, and finally the numbers turned down this month just a little bit. It went down from 169 to 166. So I don't know if this inventory build and the reduction in inventory is finally starting to uh, have an impact on that, but it is what it is. These are the numbers. Okay, moving along. This is a chart that was really a surprise this month, and this is the number of homes that sold and closed. And when you see the inventory building and you see the pending home sales going down, that's of concern for sure. But then when you look at what happened in September as far as the number of closings, we actually shot up on the number of closings. So if you look at September here, you go back to 2012, we had 2,640 closed sales, and then in September 2013, we had 2,754, and now we jumped all the way up to 33.24 for a 20% increase over last year. So that's awesome. I mean, that's good news. So anyway, that's kind of the numbers that I have right now. Take a look at the inventory. Let's see here. Anyway, that's kind of what I have. Let me see if I can get out of this thing safely and get back to you guys. Okay, there we are. Okay, so anyway, that's the number. So let's chat about that. What do you guys thoughts on the numbers? Let's mix things up a little bit. Brendan, you ready to
Sure.
fight on this?
Yeah. My concern from the buyer side is, yeah, the inventory is way up, but the quality of the homes is really poor. If you look at, hold on, let me show you. If you look at the number of the new listings, inventory overall, this is my concern here, is the 67% increase in the number of foreclosures. Okay, the quality of those houses is not very high at all, and that's probably one of my biggest concerns. What I've had discussions with a lot of my clients currently is how can they get some rehab money for these houses, because you walk into a lot of these houses, they haven't been touched for 3 or 4 years. They're outdated. Things need to be fixed, and so that's one of the concerns. And I'm starting to get more inquiries for the FHA 203 3K type loans or other type of rehab loans. We actually have one closing the end of this month that is a perfect example. She is purchasing a home off of Princeton. We were able to get it at 141. Appraisal-wise, it's coming in at $179,000, and we're actually going to take that difference, and she's basically going to get almost $40,000 worth of rehab done to this house, included in her loan. So she's all set. She's happy as can be. She's where she wants to be, and she's going to get all the upgrades that she wants. And I think what we're going to start seeing, especially with the inventory up, there's a lot of aggressive things going on out there. Fannie Mae is starting to offer agents a $1,000 bonus for selling home path homes. I've got one that we have an offer in right now that came on the market about 20 days ago. They've got to let it stay the 20 days like they're supposed to for first time for home buyers. But the minute it got past that 20 days, on the 22nd day, they dropped the price $16,000. And I told my client, sit tight, because watch I'm used to seeing about a $10,000 drop right off the bat. They dropped it $16,000. It's like, wow, that's actually priced right for a change. So the minute we got it, we got the alert that morning and over the offer. So that's we're going to continue to see more price drops as well. And that's, again, like I've discussed a couple different times. In the morning, one of the first things I'm looking at is, okay, what are my price decreases? And consistently, we're seeing 100 to 150 price decreases every single morning. The other concern is you look at the new listings, look at the sold, and you look at the pending. It used to be that the new listings were, 50, 60. Now we're consistently having more new listings than we are properties being sold on a daily basis, which means your inventory is going to continue to increase. So the inventory is going to keep going up with everything. And it offers more opportunity, but again, the quality of the homes, because a lot of these are foreclosures, they've been sitting for a long time. People aren't ready to jump into them unless they know they can fix it up, or they're looking at saying, okay, yeah, I'm buying this, but I need to still have $10,000, $15,000 in my pocket to bring it up to par. Gotcha.
Good stuff. And yeah, so you were talking about some Fannie Mae stuff, and we're going to get James's thoughts on that, and I'm sure he's got all the latest and greatest. But Alex, what are your thoughts on the numbers, and give us your side?
Well, I'm really glad Brendan brought up the price decreases number, because that's something I think we're hoping to track here going forward, hoping to provide, the report. So the fact that it's that 100, 150 number, like Brennan stated, I mean, it's something to really keep an eye on, because you're talking, even though the price has gone down of the median homes for the first time in 8 months to 166,000. With that many price decreases, it's just telling that the market is slowly turning towards the statistically balanced 5 to 6 months, and it does favor the sellers still, because we're at about a 4.23 months of inventory as we stand, supply of homes. But I think, as we stated when we first started doing these reports, even 4 months ago or what have you, it's slowly coming to that balanced market and favoring the buyers a little more than the sellers. Eventually, I mean, we're not quite there, but we're getting close.
Yeah, good point. And but the one thing that is going to be a game changer for everything, and that's the fact that the number of homes that sold last month, that being up so high, is going to help balance that out. If that continues, if that's just a one-off situation where the number of closings went up, or whether that's a
one-off.
Well, to me, you can look at that number two different ways, Phil.
Mm-hmm.
The way I look at it is as a percentage of inventory. Last year, if you look and you divide the number of sold versus the inventory, roughly 2,500 divided by 7,000, it's a much higher percentage of inventory that was sold. Look at now, you're dividing 3,000 into 14,000.
Exactly.
You've actually decreased the number of properties percentage-wise of inventory that's been sold, mm-hmm. which to me, again, feel, gut, everything, it's turning into a total buyer's market right now. They can pick and choose. They can walk away, and we're starting to get aggressive on the pricing. If it's not right, hey, sit on your hands for a week or two. Watch this. Mm-hmm. We the one we just put the offer in on, we went to another property within the subdivision, and they had it priced at $154,000. And you ask the listing agent, how are you supporting that? Well, that's what other ones are listed for. It's like, well, great. But here's your three comparables. Your three comparables are here, here, and here, and it happens to be a townhome. So townhomes are townhomes. Unless they've done some granite, some minor upgrades. But here it is, and my client just said, no, it's not worth it. We're not going to press it. Mm-hmm. Let's just sit on our hands. We did, and another one came available, and if hopefully we'll hear back today, but if we get that one and we close, it's bad news for the one who decided to sit on, who decided not to budge, because her value is actually going to decrease.
Yeah, and just to build off of what he's saying real quick, I've been telling my sellers, whether they're new sellers or whether they've been with me for a little while listing-wise, you need to aggressively price for this market. And if you're not aggressively pricing, then you're not really giving yourself every opportunity to sell the home. So
I agree with you.
Yep.
Yeah, that's for sure. I mean, that's great news for your buyers, Brendan, but our sellers are like, oh my gosh.
Got to be aggressive.
We don't want to hear that. So
yeah.
But you guys got to have 2.5 years of, no, I'm not budging. Oh, I've got multiple offers.
Yeah.
Let me sit down and look at these 10 offers I have, and I'll decide which one I feel like going. And you increase your price a little bit?
Yeah.
Yeah.
Mike?
It's good that they they see it from the other side, because that's a tough thing when you own a house and it's near and dear to you, that you just it's very difficult for you to see the other side of the equation. But the reality of it is, I mean, there's a lot more choices. But I'll tell you what, the number of homes that sold this past month, that's impressive. So that could be a game changer, and that'll be something to really take a look at next month. So So with that being said, James, what's going on the mortgage side? Give us all information and bring us totally up to speed on the mortgage side of the business.
Yeah. You guys had a lot of great talking points, so I don't even know where to begin. But you guys are absolutely right. It has switched into, well, from our perspective anyways, we're seeing prices come down, people offering less, getting more sellers' concessions. But it's like you said, if you've got a house in great condition, it's going to sell. It'll still get those multiple offers, but the majority of homes out there need a lot of repairs. In that aspect, let me do a quick screen share. You're going to start seeing more programs like this come out. I know we've spoken about escrow holdbacks before. There's the home style renovation. You still have the 203K. There's a lot of different programs that people can take advantage of. So if they have a house that they really want and it just needs, whether it's a want or a need, as long as it's permanently affixed to the house and it's not an over improvement, it can be done. Financing has a place for it. Sorry, hold on a second. Let me go back to. I don't know if you guys heard. Anybody heard about Bernanke?
Yeah, he couldn't get his house refinanced.
What's that?
Yeah.
What happened?
Ben Bernanke went to refinance his house, and he couldn't get it done.
Yeah, and he stated, he goes, I think the guidelines are way too strict. So when he stepped down, I don't know if there was an income reduction or what it was, because usually if you change jobs, it's no big deal as long as it's in the same field. But yeah, unfortunately, so he made a statement, and I think the market might take that into consideration because we're seeing a lot of different things with rates that seem to be just going kind of along with the market. Let me pull up a quick screenshot that I took yesterday. I don't know if anyone's been watching what the market's been doing, the rate sheets. So
yeah, well, the market in general, whoa, it's the stock market over the past few days. Wow.
Yeah. Well, general rule of thumb: stock market goes down, bond prices go up.
Exactly, that's right. And this is a mortgage-backed securities chart. This is what all the rates are based off of. So whenever there's, I don't know if you guys can see my arrow. Is that going around here?
Yeah.
So as you can see, we had our worst pricing in the beginning of the year, and as soon as we kind of got into a good, solid trading range, come September, we had a bond rollover. Everyone was afraid of the Fed minutes, saying that, hey, they're going to increase. Well, we already knew the tapering was coming, and so they hadn't priced it in, but they figured that the Fed is going to raise the rate mid-2015. So with that, everybody freaked out. Pricing got worse, and then all of a sudden, a couple of things happened. You had weakening foreign markets. You had the Ebola scare, and you had the Fed make a statement that pretty much they don't know when they're going to raise the rate. They're like, the market's not in a good recovery yet. We're not sure. It's pretty much they left it really open-ended, which they haven't done in the past few Fed meeting minutes. So all of a sudden we had a huge rally, and then yesterday was probably the best we've had since maybe August of last year, if not sooner. And then Janet Yellen had a private meeting, and some things were said, and all of a sudden it came back down where they're not going to use indicators. So we're not sure where the market's going to go. It's been up and down every day, but yesterday was probably our best in a long time. So I think with people,
what's that's funny, the stock market crashes and the bond market goes the other way. So that's just interesting the way that works. But yeah, so but once you finish your point, James. But man, all these rates and everything, that's that's good stuff. But how are we going to get people into houses? I mean, with the guidelines being so strict. I mean, when are they going to open this thing up?
I think that's coming. So with the go ahead. Sorry, Brian.
I've actually read where there's some companies coming back out with quote unquote subprime lending. But if you look at them, it's basically 20% down type loans. They're going to come up with some alternative programs again, very similar to what we had when we originally had I call it alternate market. All of us being self-employed, it's great. It's something that was a benefit to us because you had the stated income, you had the 12-month bank statement type programs, which were designed originally for the self-employed people. And then, of course, they opened it up to everybody, and that's when the market took the crash. I think if they consistently keep them within to what they were originally designed for, you'll slowly start to see those programs come back out and be available to people, and that should help the market, the housing market, quite a bit.
Absolutely, and another aspect of it is you're seeing more of the asset dissipation programs where they'll look at bank statements and count that as income. We have W-2 programs where they don't even look at the tax returns. So I know that doesn't help if you're self-employed, but if you are salary and have unreimbursed expenses, they won't even look at it if your W-2s cover it enough. So they're trying to loosen the guidelines enough, but yeah, we have seen the stated kind of portfolio programs where they do require more down, and it's not the best rate, but I think you're right. It's whenever you see slowdowns, lenders want to keep lending at the same volume and level that they're at, and they're going to continue to loosen guidelines because the government, as long as the government backs the loan or they can hold the loan, and it's going to start going back to more risk-based pricing instead of basing it on. You're right, because a lot of the tax returns you see self-employed, there might be a lot of write-offs, but that person can still pay their bills. So I think you're going to start seeing more of a shift to that common sense underwriting. Is this a risky loan? Am I going to have to buy this back? Which could make it for a more riskier marketplace. But I mean, FHA went down to 530 over a year some ago, and it's still being able to be financed, with very little buyback.
Yeah, that's good stuff. But what's mystifying to me is, and you mentioned it, common sense lending. Why are they so fixated on the 2-year thing and that being the guideline? Now they've extended it, even after foreclosure or a short sale. Now you can't even do it after 2 years now. I just don't understand what the rationale is there, because from a common sense approach, if they're trying to deal with risk, how does 25, 26 months make any difference? What would make more of a difference is to just down payment requirement, because that's gonna secure the loan better than going from 36 or 24 months to 36, or it just I just don't understand what they're trying to accomplish.
Phil, a lot of it has to do more with the secondary market than anything else. In that you've got to look who your buyers are of the products, okay? Because when a company portfolios a product, they're holding it and they're using their own assets to underwrite the loan. In order to continue to underwrite loans, they have to have what's called a secondary market to sell that loan off to, okay? What we've basically beat ourselves down into is having one person for the secondary market, and that's the government. That's your Fannie and Freddie. And if your loans don't fit that market, you've got no place to sell them. So if you don't have any place to sell them, you can't offer a program. And that's the reason why.
Yeah, Brendan, that's a given. We understand that. When I say I don't understand what they're talking about, I mean, frankly speaking, I'm talking about the government. What are they? What's the end game here? How can it be going from the 24-month restriction, which it originally was, to what is it now, James? It's 36, 48. What is it? 100 years?
Yeah, for FHA, 36 months, and then for conventional now it's 48 months. So you're looking at a 3-year wait for FHA, 4-year wait for conventional. But everyone's heard about the FHA Back to Work program. It's the same thing. The government's trying to mitigate the risk. They're like, yeah, if you're 1 year out from everything and you meet these minimum guidelines, we can give you a loan. I haven't seen any of the FHA Back to Work. It's almost like a lot of lenders have dropped them off. Investors aren't even underwriting them because the wording is so subjective that they're afraid that FHA is not going to back it. And there's every little reason, because the wording, it says you had to have personal credit history, pretty much summarizing. perfect credit history, have one economic event, and then all of a sudden, you're back on your feet. So now they're dictating, all right, when did you get back on your feet? Did you get back on your feet before the short sale took place? If that's so, then you're disqualified. Did you have a collection before? Oh, sorry, disqualified. It's almost like they look for a reason, to not give anybody
Yeah, and we lost you there, James. But yeah, that's the thing. It's just I don't understand. I just don't understand what they're
Well, look at it. Look at this. Look at this way, Phil. They're tapering too. Okay, so the amount of money that they're putting in is less, because what was happening is and the government was buying them. Okay, well, if you're tapering off the amount that the government is backing, okay, because QE3 is basically done and over with. Now, you can't write the same types of loans. So how do you do it? Well, you make the guidelines more stringent. Therefore, you don't have to buy as many loans. When you look at the overall picture of what they're doing economically within the government, it makes perfect sense. You're tapering down the buy of the Treasury. Okay. Well, if I'm going to buy less, I have to have less coming out. Okay. So how do you do that? You tighten the guidelines on people, and that's you've got to follow the money the whole way around the entire circle, and the funnel here and the funnel here has to decrease, and that's why they're doing what they're doing.
Slow the flow.
Yeah.
You have to.
Yeah, and that does make sense. But at the end of the day, if the real estate market ceases to exist because or basically comes to a halt because of what they're doing, they're kind of defeating the purpose, because it will come full circle. But hey guys, we've got to wrap it up. Unfortunately, we got a couple minutes here. Just wanted to thank you guys for dropping by. We'll put all your contact information in the show notes. But give me your last 30 seconds, starting with you, Alex.
Yeah, anyone looking to sell a home here in the Orlando area, more than happy to help you get it done. We'll get it aggressively priced, like we were talking about early, and get it to a sellable condition. That's really, as we spoke about earlier, all that it really takes. I mean, you just got to get it to a move-in ready condition and aggressively priced. You can reach me or text me at 407-493-8207, and you can email me at alex@YourOrlando.com.
Brandon, 30 seconds. Can you do 30 seconds. It? Can you do it?
It's for the buyers out there. Now's a great time to look. Inventory's way up. Your interest rates are still very aggressive. There's a lot of programs coming out to benefit you, and it's just a great time to start looking. It's swinging in your favor. Take advantage of it. You can call me at 407-710-8720, and you can reach me at brendan@YourOrlando.com.
And James.
Hey, thank you guys. I thought it was a great. I mean, we could talk about these topics forever. There's so much going on in the market. But yeah, if you guys have any real estate questions, please get in touch with Your Orlando. They know exactly what they're talking about. They understand the market. If you have any mortgage questions, I have received emails. Please send them. There's no questions I won't answer. Send them over. We're more than happy to take care of it and help get you guys in place. Don't forget, October is Breast Cancer Awareness Month, and if you ever need me, you can reach me at number right here, 407-970-8175. Call or text, or send me an email. Hey, thank you guys.
All right, guys. Thanks again. We'll see you guys next month. It was enjoyable, and make it a great month.
Have a great day, guys.
Bye.